Banks and banking executives usually have a pretty good take when it comes to the overarching state of the economy as well as the financial markets, and this is largely due to the fact that banking-related executives usually touch just about every transaction as it relates to money in the economy, whether it relates to mergers and acquisitions or taking companies public or credit card type of transactions or even wealth management. You usually have a bank or a banking-related entity at a core for all of those transactions, which is why these banking and banking-related executives have a pretty good view when it comes to the overarching state of the economy. Due to this, when it comes to the facts and the opinions laid out by some of these banking-related executives, it's perhaps worth a listen. While I'll touch on the thoughts and the opinions of various CEOs as it relates to the banking sector in this video, the one that I'll be primarily focused on is the most outspoken of them all, which is Jamie Dimon of JP Chase. So perhaps let's just start off with the topic that's getting the most airtime at this point in time, which is the topic of inflation.
Inflation.
Will inflation take hold?
Everyone seems to have an opinion as it relates to inflation, and there's quite a bit of fear-mongering out there as well. But at least when it comes to Jamie Dimon of JP Chase and what their opinions as it relates to inflation are, they do expect this level of inflation that we're seeing right now, which is at right about 7%, to come down quite a bit based on Fed action. Now, this is not necessarily true that it is applicable for all sectors. For example, they did highlight areas such as wages, housing, as well as oil to be areas where they do anticipate inflation to not be transitory and for it to continue for an extended period of time. When it comes to this topic of Fed action, Jamie Dimon does anticipate there to be 6 or 7 rate increases over an extended period of time, which is a bit more than the consensus estimate of 4 rate increases in the course of 2022. However, he does expect that the Fed will take the necessary action to create some sort of a soft landing here, as opposed to there being some potential risk of a recessionary type of environment.
But, if we're lucky, they can engineer a slowdown and you'll see inflation coming down. A lot of people project inflation to be 2.3% at the end of this year. I don't. I think it's going to be higher. But, if we're lucky, the Fed will slow things down and we'll have what they call a soft landing. And it's going to be a little bit like threading a needle.
Now, as it relates to a takeaway when it comes to this particular thought or opinion, it does relate to some of the pullback that is being experienced in the stock market as it relates to inflation and how these stocks may potentially be valued on a go-forward basis. Now, rising rates obviously has a direct linkage when it comes to mortgage rates as well, and we are still starting to see some of that impact in the housing market as well. For example, the 30-year fixed-rate mortgage is now sitting at almost 4%. And there's a very high likelihood that this could reach 5% in the not too distant future. Generally speaking, this would of course have some level of pullback when it comes to the overarching state of the housing market and perhaps result in some level of price stabilization. However, with that said, let's not forget the notion that there is a housing shortage of about 5 or 6 million homes at this point in time, and there's a significant amount of demand thereof, due to which perhaps some level of this stabilization may not necessarily be impacted with some of these rising interest rates. And I've talked about the rental market in other videos as well. There's not much solace there, but I'll leave a link to that up above as well as in the description below, so definitely go ahead and check that out. Now, when it comes to the area of wage and wage inflation, Jamie's opinion as it relates to this particular subject matter is that companies just need to get along with it. If they want to get the best talent into their doors, and considering the number of shortage or the amount of shortage that there is out there when it comes to getting the right level of talent for the right compensation, companies just need to go ahead and fight to get that best talent, and if it results in some level of operating margin or gross margin reduction in the short term here, so be it. Rising wages when there is a significant worker shortage is just par for the course. This, of course, means more money in people's pockets, therefore more savings as well. And when you have more money in people's pockets, more savings, more spending, that overarchingly is good for the overarching state of the economy. Now, when it comes to that overarching state of the economy, Jamie Dimon does expect to see some crazy level of growth into 2022 all the way into 2023 as well.
But the consumer balance sheet has never been in better shape. They're spending 25% more today than pre-COVID. They've got $2 trillion in their checking accounts. They have the wherewithal to spend more. They've paid down a lot of debt. Their debt service ratio is better than it's been since we've been keeping records for 50 years. Home prices are up, stock prices are up, jobs are plentiful, wages are going up. And that all tells you what's going to happen in the future. they're in pretty good shape.
And this in spite of a significant drop off 12.5% in the University of Michigan consumer confidence number, CPI hitting 7%, and of course Omicron surging. Now it is no secret these banks are all flush with cash and at record levels. So this capital that they have has of course to be utilized or deployed in some manner. So when it comes to the topic of capital utilization, Jamie Dimon at JP Morgan Chase did come out and say that they're expecting to do some unprecedented level of investment in the business. For example, JP Morgan is spending $77 billion this year on technology, marketing, and wage-related items. On the earnings call, they did specifically highlight, as it relates to tech investment, of a significant amount of modernization as well as migration to AWS cloud for a lot of their platforms and services. So what are some of the key takeaways as it relates to some of this feedback that is being received from a lot of these banking leaders? It really comes down to just about four things. Firstly, they do expect the economy to continue to be strong, and they do expect consumer spending and saving to continue to increase. Secondly, the best companies are going to continue to invest in technology as well as wages to retain the best talent on a go-forward basis. Thirdly, while they do expect certain pockets of inflation to continue for an extended period of time, they do also believe that the overarching inflation rate will subside. Fourthly, while there's going to continue to be a lot of chatter and fear-mongering as it relates to inflation and the associated Fed action, they do not expect this to be a significant issue over the long term. Of course, if you're a long-term investor, none of this should essentially matter, and the best course of action continues to be to invest in the market on a fairly regular basis in a diversified portfolio of stocks as well as other investments. If you enjoyed the contents of this video, don't forget to like, subscribe, and ring that notification bell, and I'll see you in the next one.